So this is a trial balance of this investment trust fund. So these investments are being established so we have that Campbell County sold tax-supported bonds in the amount of $15 million to finance construction of roads and bridges. The proceeds of the bonds are added to the investment pool until they are needed for capital budget fund distributions. So in this way, the amount of cash that we received from any bond issue, we are collecting interest on until we need it to cover. So we would have various journal entries then to require that. So we sell tax-supported bonds and we distribute those investments, and then that $15 million of it is due to Capital Projects Fund. The bond sold at a premium, so we have 310 more. 310,000 because of that premium on the fair value of these bonds. Okay. Then we would have this investment fund balance after that $15 million bond issue where we have them available. Okay, so that's just an example of a small example of what an investment trust fund might look like and the reporting done for an investment trust fund. Then we also have private purpose trust funds. So this is trust agreements to confer asset or management of assets to another party for a specific purpose. So this is what I was talking about, where we would have principal or corpus of the trust. If that principal has to be held intact, which means the principal can never be spent and only the earnings can be spent, then it's called an endowment. The income from these private purpose trust funds can only be used for whatever the purposes are specified by the trustor. So like I said, if I gave $1 million to the city and I said it could only be used to plant flowers in parks, then that is the only thing they could ever use that money for unless they had the terms of that contract changed or that trust agreement. So as I said, the management of these private purpose trust funds or endowment funds is generally what they get called on a large basis, has to be, we have to make sure that we're following the terms of those trust agreements. Okay, public and trust funds, so we would have like the public trust-like funds where the principal income and or both have to be used for a public purpose. So governmental activities where we could say like we're funding maintenance of a cemetery, or we're funding a beautification of the downtown area, in which those are general governmental activities that they might normally use budgetary funds for, but now we have a public trust that we're available to use. Okay, where private trust funds are beneficiaries are not the general public, so it's not a public purpose, and then those are treated as fiduciary activities where we are custodial accounts rather than actually the public purpose accounts. Okay. We also have pension trust funds. So pension fund accounting uses accounting-based approach. These are pension liabilities and expense under the economic resources measurement focus. Most governmental employees have a dictated pension. So for example, like the state of Iowa and all city employees within the state of Iowa, city and state employees within the state of Iowa would have an IPERS fund, where both the government and the individual employee are contributing into that IPERS fund, which is a pension fund. We would also have police and fire often have legally defined pension funds that cities and states need to be and counties need to be cognizant of for those different pension requirements. Okay, so we have different kinds of pension plans. So we have a defined contribution plan where the amount or rate of contribution is specified. So we might say, so for example, like a defined contribution, we would say that in a defined contribution plan, the employee and the employer have a set percentage rate of contribution. I think the current IPERS set rate is 6% from both the employer and the employee side. It's a non-optional contribution. It has to be made. A defined benefit plan is that the amount of the benefit is specified, and this uses actuarial calculations, and actuarial calculations are looking at length of employment, the annual salary, the age of the person. One of the things that actuarial tables do is risk management. They also do like death predictions. So, you know, when you see that it's like the average age of men from this state is 78, that's an actuarial calculation. So that helps to determine what is actually needed in the future, dependent on these various factors. The IPERS that I had mentioned earlier is a defined contribution plan. Okay, so we have defined benefit plans where we have single employer pension plans and multiple employer pension plans. In the multiple employer pension plan, assets of all of the employees are pooled for investment purposes, but accounts are maintained for individual employer participants. And in the single, pensions are provided only to employees of the employer. So this is where how we pool that money for investment and management. And then we have agent or cost sharing purposes. Cost sharing is what I just said, where a lot of employers and people are pooled together, and then all assets can be played out to any benefits of any employer who shares in this plan, versus an agent-based plan. Okay, an agent one, plan benefits, this is where the plan benefits are pooled, but individual accounts are kept out for individual employers. So, of course, required financial reporting. We need to have a statement of fiduciary net position showing plan assets and a statement of changes in fiduciary net position. We would also say like what our obligation is and what the amount that we have saved towards that obligation is. the state of Illinois actually had a famous case several years ago where they had some issues where they did not have enough money saved up compared to what their defined pension obligation was. And they were running into financial issues because of the management of their defined plans. Okay, so we have required reporting on this fiduciary net position, changes in fiduciary net position, and then those detailed notes and required supplementary information, which help to define what our plan is, who manages our plan, what the payment out is, what the investment policies are, what our pension liability is. So we have to include a 10-year schedule of pension liability and and a schedule of our collections and how those collections are going to manage that liability. So basically, it's just what is our defined pension plan? How are we investing those funds? How are we maintaining that we have enough to pay our current and future liabilities? And then what are our projected payouts from that plan? Okay, so we have the statement of changes in fiduciary net position. All fiduciary accounts have this statement where we have net position rather than revenues, and then we have benefits paid or just deductions. So we look at additions and deductions rather than revenues and expenses. So this is an example of that statement of changes in fiduciary net position where we have what were the additions. So we have from the employer, from the plan members, and then the income from our investments, both in interest and dividends, and then we have our fair value adjustments. Of course, we know that one of the issues of trading on the stock market is that with fluctuations, our value in the stock can actually decrease when the stock market goes down. And so we could actually have a negative value of investment change just because of stock market fluctuations. And this is something that fund accounting is paying a lot of attention to especially risk management of investment. So if this sounds interesting to you, you're really interested in like financial advising, in investing funds and risk management, actually fund accounting might be something that you are very interested in because that's one of the activities of a fund accountant. Okay, and then we have what are the deductions? So where we've paid out for disability benefits, retirement benefits, and then refunds to terminated employees. So when a person leaves a company, they usually get their own contributions back to invest in a different retirement account, whether company sponsored or private. And then there's a vestment period where you would have to be vested, or what's called, so for like example in IPERS, you have to work for 3 years to be formally vested. And so you would only get your contributions if you leave before you're vested. If you leave after you're vested, then you would also get any employer contributions that had happened during that time. Okay, and then we will discuss the rest in the next video.